Options. For many investors, that word immediately creates confusion. You hear terms like calls, puts, volatility, Greeks, theta, spreads, strategies, and it can feel like the learning process is entirely a new language. But at its core, an option is simply a financial tool designed to give investors flexibility. Today, we're going to break down options from the ground up and help you understand how they work and why professional investors use them and why risk management is the most important part of any option strategy. Hey, it's Frank Nagy and welcome to my channel where we help investors understand various market environments, risk management, and alternative investment strategies. If you're new here, subscribe to my channel and hit that like button. An option is a contract that gives the buyer the right but not the obligation to buy or sell an asset at a specific price within a specific time frame. Think of it like having a choice. There are two basic types of options. A call option gives you the right to buy something at a predetermined price. A put option gives you the right to sell something at a predetermined price. For example, imagine a stock is trading at $100 a share and you believe the stock may rise. You could buy a call option that gives you the ability to buy that stock at $105. If that stock moves significantly higher, that option may increase its value. On the other hand, if you believe the stock may decline and you could buy that put option, that increases in value if the stock falls. The important things to know and understand is this: options are not just about predicting direction. They are about managing different market outcomes. The price you pay for an option is called the premium. That premium is influenced by several factors. The first one is the underlying price of the asset. If the stock moves closer to your strike price, the option value is going to increase. The second is time. Options have expiration dates. Time an option has remaining, generally the more valuable it is because there's more opportunity for that market to move. The third major factor is volatility. Volatility measures how much movement the market expects to make in a period of time. Higher expected movement usually means higher option premiums. This is one of many strategies Theta Bridge Capital Management applies when managing non-directional investment portfolios with a focus on disciplined risk management and adapting to evolving market conditions. Many beginners focus only on whether the market goes up or down. Professional option investors also focus on something else: how much movement is already priced into the market. For example, investors expect a major market move. Option prices may become expensive because volatility increases. If fear decreases and volatility falls, option premiums may decline. This creates opportunities because options are not only about market direction, they are also about understanding whether options are priced efficiently and the difference between the expected volatility and the actual market movement can create opportunities for disciplined investors. You will often hear option traders talk about the Greeks. These are measurements that explain how option prices react to different factors. The first one is delta. Delta measures how much an option may change based on the movement in the underlying asset. The second is theta. Theta represents time decay. As an option gets closer to expiration, time value generally decreases. And the third is vega. Vega measures the sensitivity to changes in volatility. If volatility rises, some options may increase in value even without major market movements. Understanding these concepts help investors move beyond simply guessing market direction. The biggest mistake many new option traders make is focusing only on potential profit. Options can provide leverage, but leverage works both ways. A successful approach begins with understanding risk. Professional investors often focus on questions like, how much capital am I willing to risk? What happens if the market moves against me? How does this position affect my overall portfolio? Risk management means creating a process before entering the trade. It means understanding the probabilities, and position sizing and diversification and having a plan. The goal is not to avoid losses completely. Losses are part of investing. The goal is controlling losses so that one decision does not damage your entire portfolio. Options do not have to be complicated. The goal is to understand markets better and make more informed decisions. To learn more about Theta Bridge Capital Management, our investment strategies, risk management approach, and portfolio construction process, click on the links below in the description box.